Hey everyone, welcome back to the channel. Have you ever wondered how your simple checking account connects to massive global institutions like the IMF? Or how the money in your bank actually powers the entire world economy? Today, we're diving deep into how the global financial system really works. We'll start right where you interact with it every day, your personal bank accounts, and build up to the big players like investment banks, hedge funds, central banks, and even the International Monetary Fund. Stick around because this is going to blow your mind. It's like a giant web that keeps the world spinning. Let's jump in. Imagine this: you get your paycheck and deposit it into your checking or savings account. Super basic, right? That's the lowest level of the financial system, retail or commercial banking. Banks take your deposits, keep them safe, mostly, and pay you a tiny bit of interest on savings. But here's where it gets interesting. Banks don't just sit on your money like a piggy bank. They operate on something called fractional reserve banking. Simply put, banks are only required to keep a small fraction of deposits on hand as reserves, historically around 10% in many places, though in the US it's been 0% since 2020. The rest, they lend it out to other people for mortgages, car loans, business startups, you name it. So, when you deposit $1,000, the bank might keep $100 and lend out $900. That borrower spends the $900, it gets deposited somewhere else, and that bank lends out most of it again. This creates a multiplier effect, expanding the money supply and fueling economic growth. Without this, the economy would grind to a halt because there wouldn't be enough money circulating for loans and investments. But banks aren't just lending to individuals. They also handle payments, think debit cards, wire transfers, ARC payments, that keep money moving seamlessly. Commercial banks are the foundation. They connect savers like you with borrowers who need cash to buy homes or grow businesses. If you are liking this video, go ahead and click the like and subscribe button to be notified of our latest updates about money and finance. Now, let's zoom out a bit. Those loans and deposits feed into bigger financial markets. Companies need more than just bank loans to expand, they issue stocks and bonds. This is where capital markets come in, stock exchanges for buying shares in companies, and bond markets for lending money to governments or corporations. Enter investment banks. These are the power players, like Goldman Sachs or JP Morgan, that help big companies raise massive amounts of capital. They underwrite initial public offerings, IPOs, meaning they help a company go public by selling shares to investors. They also advise on mergers and acquisitions, think helping one giant company buy another. Investment banks facilitate huge deals, trade securities, and provide research to guide investors. They're the bridge between corporations needing funds and the investors who have them. Then there are hedge funds. These are like the high rollers of the financial world, private investment pools for wealthy individuals and institutions. Hedge funds use aggressive strategies, borrowing money to amplify bets, leverage, short selling, betting stocks will fall, derivatives for hedging risks, or arbitrage to exploit tiny price differences. They aim for absolute returns no matter if markets are up or down. Hedge funds add liquidity to markets, help price assets efficiently, but they can also amplify booms and busts because of their size and risk-taking. All this activity, retail banking, markets, investment banks, hedge funds, happens within countries, but it's overseen and influenced by central banks. Think the Federal Reserve in the US, the European Central Bank, or the Bank of England. Central banks are the conductors of the orchestra. They set interest rates to control inflation and growth. If rates are low, borrowing is cheap, economy booms. If high, it cools down. They also act as lenders of last resort during crises, pumping money into the system to prevent collapses. And crucially, central banks manage the money supply through tools like buying, selling government bonds or adjusting reserve requirements. In a crisis, like 2008 or the pandemic, they flood the system with liquidity. Central banks ensure stability at the national level, but their actions ripple globally because currencies fluctuate and capital flows across borders. Finally, at the very top, the macro, international level, we have institutions like the International Monetary Fund, IMF, and the World Bank. The IMF monitors the global economy, provides loans to countries in trouble, like during debt crises, and promotes stable exchange rates and monetary cooperation. It's like the emergency responder for nations. If a country can't pay its debts or faces a currency crash, the IMF steps in with bailout packages, often with conditions to fix underlying issues. The World Bank focuses more on development, lending to poorer countries for infrastructure and poverty reduction. Together, these Bretton Woods institutions, named after the post-World War II agreement that shaped them, help prevent global financial meltdowns and coordinate policies among 190+ member countries. So, there you have it, from your checking account creating money through loans, up to hedge funds trading trillions, central banks steering economies, and the IMF safeguarding the whole system. It's interconnected. A crisis in one part, like a bank run or hedge fund blow-up, can spread fast. But when it works well, it drives growth, innovation, and prosperity worldwide. What do you think? Is this system genius or too risky? Drop a comment below, hit like if this cleared things up, and subscribe for more breakdowns on money and economics. Thanks for watching. See you next time.